Hello everyone, welcome to this video. In this video, I'm going to talk about an article which is called Five Types of REITs and How to Invest in Them. So, real estate investment trusts are a key consideration when constructing an equity or fixed income portfolio. They provide greater diversification, potentially higher total returns, and or lower overall risk. In short, their ability to generate dividend income along with capital appreciation makes them an excellent counterbalance to stocks, bonds, and cash. Real estate investment trusts own or manage income producing commercial real estate, whether it is the properties themselves or the mortgages on those properties. You can invest in the companies individually through an exchange traded fund or with a mutual fund. There are many types of REITs available. Here we look at a few of the main categories of REITs and their historical returns. By the end of this article, you should have a better idea of when and what to buy. So, the great uh, takeaways of this article are using REITs to invest in real estate can diversify your portfolio, but not all REITs are created equal. Some REITs invest directly in properties, earning rental income and management fees. Others invest in real estate debt, mortgages, and mortgage backed securities. In addition, REITs tend to be focused on a specific sector of properties. For instance, retail or shopping centers, hotels and resorts, or healthcare and hospitals. One of the biggest benefits REITs have to offer is their high yield dividends. REITs are required to pay out 90% of taxable income to shareholders. Most REIT dividends don't meet the IRS definition of qualified dividends. So now we have five types of REITs and how to invest in them. So first, historical returns of REITs. Real estate investment trusts are historically one of the best performing asset classes available. The FTSE Nareit Equity REIT Index is what most investors use to gauge the performance of the U.S. real estate market. Between 2010 and 2020, the index's average annual return was 9.5%. More recently, the 3 year average for REITs between November 2017 and November 2020, 11.25%, was well above both the S&P 500 and the Russell 2000, which clocked in at 9.7% and 6.45% respectively. Historically, investors looking for yield have done better investing in real estate than fixed income. The traditional asset class for this purpose, a carefully constructed portfolio should consider both. So, retail, first we have retail REITs. Approximately 24% of REIT investments are in shopping malls and freestanding retail. This represents the single biggest investment by type in America. Whatever shopping center you frequent, it's likely owned by a REIT. When considering an investment in retail real estate, one first needs to examine the retail industry itself. Is it financially healthy at present, and what is the outlook for the future? It's important to remember that retail REITs make money from the rent they charge tenants. If retailers are experiencing cash flow problems due to poor sales, it's possible they could delay or even default on those monthly payments, eventually being forced into bankruptcy. At that point, a new tenant needs to be found, which is never easy. Therefore, it's crucial that you invest in REITs with the strongest anchor tenants possible. These includes grocery and home improvement stores. Once you have made your industry assessment, your focus should turn to the REITs themselves. Like any investment, it's important that they have good profits, strong balance sheets, and as little debt as possible, especially the short term kind. In a poor economy, retail REITs with significant cash possessions will be presented with opportunities to buy good real estate as distress prices. The best run companies will take advantage of this. That said, there are longer term concerns for the retail REIT space in that shopping is increasingly shifting online as opposed to the mall model. Owners of space have continued to innovate to fill their space with offices and other non retail oriented tenants, but the subsector is under pressure. Thanks for watching this video. Please stay tuned for our next videos.